Good afternoon. This is John Mousseau. I'm the president and CEO of Cumberland Advisors, the Moose. I'm wearing my moose tie today. And I want to wish everybody out there a very happy and healthy new year and look forward to a great 2020. Just wanted to recap a little bit about bonds as we've ended 2019. And as stocks had a great year, and my colleague Matt will be talking about that later this week, bonds have had a heck of a year too. So when people talk about it being an everything year, it was that kind of a year. To give you an idea where rates were, if you went back to the end of last year, rates had already started to come down from their peak. The 10-year bond had peaked at a 325 late last fall. By the time it closed, December of last year, it was around a 270. By the middle of this summer past, it had climbed all the way down to a 145. That was during the time of concern about negative rates in Europe and whether we were actually possibly going into a recession. And as we sit here today, that 10-year bond has climbed back to above a 190. So it's been a bit of a topsy-turvy in the last couple of months. Our view is that rates were probably too low in the middle of the year, and they were probably too high at the end of last year. To give you a framework for that, core inflation, which we look at regularly, at the end of last year was about 2.2. So if you think about where you were, you had a 270, you had 2.2% core inflation, you had a positive real yield of about 0.5%. As you close this year, and you have a 10-year bond of around a 190 to 195, core inflation is about 2.3. So you have a real yield of negative 3%. That's a pretty good shift. Similar drops were seen in tax-free bonds as well. But what that negative real rate means is that we have been playing defense on bonds. And we will probably continue to play defense on bonds as we see two trends continue. Probably some movement in rates to get back to and possibly go above the rate of inflation to get that real yield back. And the other trend we see is this movement away from negative interest rates that we saw in Europe. You've already seen a very particularly big climb from a negative 0.7% yield on the 10-year German bond to slightly negative, just a little below zero. That is a pretty good movement. And the idea that international rates are getting off this floor and possibly going to positive rates, we think is very good. We think Christine Lagarde, the new head of the ECB in Europe, European Central Bank, is looking away from negative interest rates and possibly more towards countries' fiscal stimulus to help move their economies along. So in that regards, we think that's a good thing because our view is that these flat yield curves hurt banks, and in fact, you need a good banking system to move economies along. As we sit here now, in the last few months, the yield curve here has gotten much steeper with the difference between short-term rates and longer-term rates. So as we enter the 2020, it's probably a pretty good backdrop for banks starting to make money on loans, etc. So as we close the year, we wish everybody nothing but good things for 2020. And we are playing defense on bonds, and it's been a good year in bonds, but we don't want to give it back, which is why we're playing defense. Have a great night, everyone.